Hey, I'm Gene Goldman. Here's a look at the week ahead for the week of June 5th. So let's start with last week. Despite some potential early drama, the debt ceiling standoff ended with a whimper. The bill easily passed both the House and Senate. Stock market finished sharply higher last week. Looking at this week, expect a pretty quiet week. We have very little economic data. First quarter earnings season is pretty much over, and this is the week before the Fed meeting. So the Fed's basically in a blackout period. They won't be doing any speeches. They won't be talking about the economy or interest rates. With all this said, though, I want to use the opportunity to discuss something we're hearing a lot in financial press that's concerning to markets, concerning to investors, is poor market breadth. So let's talk about what it is and indicators that we watch to measure market breadth. So market breadth indicates the number of stocks rising relative to those stocks falling. Overall, it indicates the robustness of the stock market as a whole. Positive market breadth indicates more stocks are advancing than declining. It's a bullish sign and it's positive for market momentum. Poor market breadth is a disproportional number of declining stocks. Basically, there's a low number of stocks advancing. It's a very bearish sign. There's multiple ways to measure market breadth. One measure that we look at is the percentage of stocks trading above their 50-day moving average. You look at this chart here, just 27% of stocks in the current rally that we're in right now are trading above their 50-day moving average. It's a very super low number. So the point here is that markets are up, but the majority of stocks are not participating in this rally. Another way to measure market breadth is to compare the market capitalization versus the equal weight performance of an index. So let's just say the S&P 500. So if you look at the S&P 500, market cap is a traditional measure, and we can spend hours discussing, but in the index, the larger the company, the greater the weight in the S&P 500. So therefore, larger companies can disproportionately drive the index, drive the return of the index. Equal weight, on the other hand, is that each company in an index is assigned the same exact weight. So you see in this chart here, comparing these two methodologies, the S&P 500 is up double digits, but the equal weight S&P 500 is up just around 2%. So you take this and some anecdotal evidence. For example, in the first quarter, 10 stocks drove 87% of the return of the stock market. Or year to date in the S&P 500, the top 5 stocks have returned over 50%. That's 10 more times than the remaining 495 stocks in the S&P 500. What does all this mean is that there's a staggering small number of stocks driving year-to-date performance in the market despite the rally. So here's the key takeaway. And again, I apologize, we had a very, very intense number discussion today, but the key takeaway is that the markets are enjoying strong performance year to date, but there's poor market breadth, and this could be a bad omen for future performance. Thank you for listening. For more information, please follow us on Twitter at Cetera IM. See you next week. Thank you.